the Digital Nomad Tax Handbook. I'm Vincenzo Villamena, CPA, founder of Online Taxman, and I'm going to tell you the top 5 tips that digital nomads must know if they're going abroad. So if you're a digital nomad, this applies to you. Number 5, as a U.S. person, you must file a tax return even if you're living abroad. As you can see, there are different thresholds depending on if you're a single filer, it's $3,850. If you're head of household, which means you have a dependent, then it's $20,800. If you're married filing jointly, it's $27,700. If you're actually married but you're filing separately, it's only $5. And then if you're self-employed, like an independent contractor, it is $400. And with these thresholds, no matter where you are in the world, if you're a U.S. citizen or green card holder, you have to file. 4, if you're a digital nomad and you want to go abroad, you really want to keep your U.S. address and phone number, right? And this could be an address of either a family member, this could be a virtual address, but the point is that you want to have access to all your U.S. mail, your U.S. tax filings, any sort of correspondence, whether it's from the IRS, the banks, etc. And the only way to do that is by maintaining your U.S. address and phone number. There's been too many times where I've seen digital nomads that haven't been able to access bank accounts, haven't been able to do, two-factor authentication, right? Because they have a cell phone in a foreign country and they're not able to receive text messages. Same thing for banks. I've seen banks that have, shut down people's accounts because they did not have a U.S. address. And keep in mind, it has to be a residential address, not a P.O. box. So again, it's good to have a P.O. box for scanning mail and so forth, but if you truly want a bank account or brokerage account in the United States, it needs to be a residential address. 3, move to a tax-friendly state. I cannot emphasize this enough, especially if you're from a state that's aggressive like California or Illinois or Massachusetts or Virginia. Move to a tax-free state and move it on paper, but what I mean by that is don't have any ties to that state. Okay, some of the states that we prefer are Texas, Florida, Nevada, Washington, Alaska, South Dakota, Wyoming, and Tennessee. Those are the tax-free states of the United States. So the question is, of course, what does that mean? Okay, that means first that you have to slash ties with your state. So if you're from California, that means getting rid of that driver's license. For example, in South Dakota, you could go and spend only one night in South Dakota in a hotel, and the next day you go to the DMV with your hotel bill and you will get a South Dakota driver's license. All right? Number 2, voter registration. Okay? If you want to vote, don't vote in the state that you're from. Get a new voter registration, because that is one way that they will track you down. Of course, if you have any sort of lease or if you own a home in that state, then you really have to show that you are no longer going back to that home, right? So that means breaking the lease. That means if you own the home, you either sell it or you rent it out long term. But the point is, you cannot show that you still have property in that home and that you still have your belongings in that state. As I said before, the next one, mailing address. And I'm talking about you cannot receive any mail to California, let's say. If you even have a brokerage statement or your W-2 or any type of tax document that's filed with the IRS, then the state of California will think that you're still living there and they will come after you. I've seen this hundreds of times, folks. Bank accounts, also, if you move to another state, at least on paper, you do not want to have your bank account registered to California for this matter. And also, health insurance and doctors. This is a big one. If you are able to prove that your doctors are not in California, let's say, and elsewhere, then you will essentially be able to show that that is the state that you reside in. The government really looks at doctors and other type of social, cultural, religious ties. So again, things like church or any type of other religious associations, even your gym membership, even your library card. The more information you're able to show outside of your state, the better it will be if you get a letter from your state asking for money. Slash those ties. 2, watch out for taxes owed in visiting countries. A lot of this is based on where your residency is. The loose rule is 183 days, which is half the year, is what makes you a resident of a country. Now that's a very generic rule, and each country is different. But if you really want to play it safe, spend under 183 days in the country that you're living in. Some countries have territorial taxation. That means that only money that's earned within the country is taxable. So let's say you're living in one of these countries, Georgia, Panama, Malaysia, Costa Rica, but all your income is coming from the United States, and none is earned locally in Panama, let's say, then that's not taxable. So if you really want to be safe, move to a country with territorial taxation. Also, check the visa requirements, all right? Each country has different visa requirements, and depending on what visa you fall under, could affect your taxation. There are other countries where if you're a permanent resident of that country, you're taxed in that country. So it's really important before you get your visa, before you get residency, to look at the different visa options and understand what happens from a tax situation based on your residency visa. And then finally, look at tax treaties and totalization agreements. A lot of times tax treaties allow for a dollar for dollar credit. So if you're either paying tax in the United States, you might be able to get a credit in the country you're living, or vice versa. Same thing with totalization agreements, except that applies to Social Security. So really do your homework, do your research, and understand the tax implications of the country that you want to spend the most time in, and be very aware of that. Number one, the Foreign Earned Income Exclusion. The Foreign Earned Income Exclusion allows for $120,000 of tax-free income if you're a U.S. person living abroad. Now there are two ways to qualify for this test. As a digital nomad, most qualify under the physical presence test. What that means is 330 days outside of the United States, all right? In reverse, that means that you could only spend 35 days in the United States, okay? One thing to know is that is over a 365-day period. It's a 12-month period. That does not mean a calendar year. So in other words, if you leave on July 1st of this year, and then fast forward July 1st of next year, if you're outside the U.S. for 330 days, then you would qualify for the Foreign Earned Income Exclusion. And in that particular scenario, you would have roughly 6 months this year and 6 months last year where you would have excluded income. So of that 120, roughly 60,000 will be excluded from U.S. taxation. So count your days. Be very, very careful of things like international waters. So if you're going on a cruise, like the Nomad cruise or what have you, that time that you are in international waters, let's say crossing from Europe to the Americas, that counts as time in the United States. So then that would obviously limit your amount of time that you could actually spend physically in the United States. All right? The other thing is just travel days in general. If let's say you are flying from Chicago to Mexico and your flight is at 11:30 p.m. And so when you're going in the airplane down to Mexico, you are still in U.S. airspace when the clock strikes 12, then that means that that next day counts as a U.S. day. So be very, very careful about the amount of U.S. days you spend and all of your travel, whether it's through or over the United States or international waters, because that 35-day rule in the U.S. is a hard rule, and if you make a mistake, it could cost you tens of thousands of dollars. Be very careful about that. I've seen it happen. The other way to qualify for the Foreign Earned Income Exclusion, and bear in mind this is an either-or scenario, meaning you don't have to hit both, you just have to hit one. So you're either physically present 330 days outside the United States, or you have a bona fide residence, which means that you have a visa, you have all these ties to a country. Now, whether it's a bank account, visa, long-term lease, etc. Very similar to the ties that we discussed in the state situation. So if you get your residency in a foreign country and you're living in that foreign country for most of the year, then you could qualify under the bona fide residency. Now, obviously we're talking about digital nomads. Digital nomads like to travel, hop from place to place, 1 month here, 1 month there. So a lot of times the bona fide residence does not apply, but I want to give people the option in case they do decide to settle down. I also want to have one other point. Just because you get a residency in a place like Panama or Paraguay or Dubai, and you're there for a week out of the year, that does not constitute a true residency for this bona fide residency test. So be very careful on those type of schemes. Now, to understand what the foreign earned income exclusion applies to, it applies to things like salary, or wages, or a bonus, or commission, or any sort of self-employed income. This income can be earned whether you are employed by a U.S. company or a foreign company. If you're self-employed, you're an independent contractor, you're getting a 1099 to your person, to an LLC or an S Corp that's set up for you. It does not matter where the income's coming from. It matters where you are earning it. That's why it's called the Foreign Earned Income Exclusion. Because if you're physically located outside the United States and you're earning that income outside the United States, then that income qualifies. One other thing to note is Social Security and self-employment tax still applies. So even if you get the full 120K excluded, if you're an independent contractor or if you're a W-2 employee and they're doing withholding, you're not going to be able to claim that money back. Any type of Social Security, self-employment tax still applies even if you qualify for the Foreign Earned Income Exclusion. Now, what does the FEIE, Foreign Earned Income Exclusion, not apply to? It doesn't apply to interest or dividends. It doesn't apply to capital gains. It doesn't apply to rental income. It doesn't apply to pension or Social Security. So again, a lot of times when people retire abroad, this might not apply. And as you can see, all these types of income are passive income. You are not actively working for that income. You are passively earning that income. And hence, it does not apply under the Foreign Earned Income Exclusion. So again, to claim the FEIE, the Foreign Earned Income Exclusion, you need to file Form 2555 and Form 1040, which is the regular tax return. And really, again, if you qualify under the physical presence test, it is so important to track your dates, your entry and exit dates in the United States. Because first, that is something that you need to fill out in the Form 2555 for this exclusion, and it's something that the IRS will want to know. And if you're ever audited, they will want to see all your passport pages. They will want to see all the documents that show that you're outside the United States. One other thing, it's not as relevant for digital nomads. However, there is something known as the foreign housing exclusion. The foreign housing exclusion is if you pay a certain amount of rent, that's roughly around $15,000 annually. You can have an additional amount of income that's excluded. So if you pay $25,000 a year in rent, the first $15,000 does not count, but anything over that amount, so in this case $10,000, can be added to the $120,000. So in this case it would be $120,000 FEIE and another $10,000 foreign housing exclusion. Again, it doesn't apply to digital nomads because if you're doing hotels, etc., then it won't count. But for people that actually do rent an apartment outside the US, it would. One other thing is the foreign tax credit. This is a dollar for dollar credit on US tax for taxes paid in a foreign country. This could apply for earned income or passive income. In this case, we're talking about earned income. So if you're physically working in another country, earning income, paying tax, you would get the credit. However, if you're deciding to take the foreign earned income exclusion, then this wouldn't count. So you can't double dip and take both. Let's do a real world example. We have Mike here. He earns $80,000 a year. All right, single father. He becomes a digital nomad. He used to live in California. He goes through all the steps to cut ties, etc. He ends up going around Colombia, Portugal, Spain, etc. If he's only abroad in scenario one, he doesn't know about the FEIE. And he only stays abroad for 9 months out of the year. He maintains his California residency. He maintains his home, his mailing address, etc. All right, he's going to pay taxes to both California and the IRS, roughly 31% of tax on that $80K. In scenario two, Mike stays abroad for 11 months out of the year. He files it and he qualifies for the foreign earned income exclusion. Okay? He also cut ties with California. He transfers his address of record to Florida, so there's no withholding on his W-2. Nothing is being received in California. He has no ties. All right? In that case, he would have no California tax. He would have no IRS taxes. And so his total tax would be zero. Not bad. Now we're going to have a bonus topic being a digital nomad, which is I have a W-2 job. I'm an employee. What will my U.S. employer think about being a digital nomad abroad? The answer varies. Okay? Most employers aren't very happy about people that are living abroad, and the reason is permanent establishment. Okay? You want to avoid triggering those rules. And to not get into complex tax jargon, but a permanent establishment is when you have employees or an office that's outside of your jurisdiction. So in this case, outside the United States. So really what this means is that there is an unintended consequence that you might fall into. Your employer might unwillingly find itself in a tax obligation because you choose to live outside the United States and nomad it up. Now, permanent establishment is a lot more complicated than that. All right, it depends on the rules of the residing country, the length of stay, what types of activities you're performing out there, and knowing how many weeks you can stay without triggering the permanent establishment rule is really important to talking to your employer about this. Another solution would be to not actually be technical employee of that company, but to be a 1099 freelancer. I've seen many times where people have decided that they're not going to go back to the office anymore, and hence their employer switched them from a W-2 employee to a 1099, which eliminates the risk for the employer. And that's it. So if you have any questions about what it means to be a digital nomad, tips, and of course the tax implications, reach out to us at Online Taxman, and we'll be happy to help. Thank you.